Hey, this is Jeremy and Cody, Crazy Wealth Management, Wealth Tip Tuesday. Hey, today with all the coronavirus and all of the volatility in the markets, and yeah, we do have volatility in the markets if anybody forgot. I know it's kind of been a smooth ride going back since really 2008. We've had some hiccups in 2015, 2011, and 18, but for the most part, a resilient market. So with that, we've had a lot of happy, complacent investors. So with volatility, we thought it'd be ideal time to throw out this for Wealth Tip Tuesday. So we're gonna be talking about the key to any type of investment strategy is having a IPS. What's an IPS? An investment policy statement. So we're gonna dive right into it, talk about the ins and outs of an investment policy statement.
Yeah, so I'll start it out. You want to make sure that you know why you're investing. The why of the investing, we're going to call it the purpose here on the board. So basically, this is your goal. Why are you putting money back? Why are you saving? Why are you in the market itself? So you want to make sure you have this defined before you start investing at all, because it really changes the way you invest. First we'll start out. We'll break it down. The time horizon. So if you're getting closer to retirement, you're not going to be extremely aggressive. If you're a younger client, you're going to be a little more aggressive than the client that's closer to retirement. So we'll go down to the liquidity needs. What are these funds going to be used for? Do you have to access them in case there's special events that come up? If you have a medical emergency, do you need to access these funds? We're not going to put them in something that that may have some type of a fee to get out of. The next would be risk capacity, and this goes into the volatility side of it. The closer you are to retirement, like I said, or whatever your goal is, or whenever you want to access the funds, the lower the risk you typically want to be. So, when we do see volatility creep into the market, that risk capacity really comes into play. That risk number we use a software called Riskalyze that really measures that risk. So we want to make sure the risk capacity is honed in before we do anything that involves any investment.
And if you don't know your risk number, give us a call, because I think this is one thing where people usually get a generic investor risk tolerance little summary thing that you fill out, check the boxes, then abracadabra, you're a moderate conservative or moderate aggressive or whatever it is. And this Riskalyze software actually quantifies based off kind of the psychological aspect of investing, and then how your attitude towards losses over a 6-month period. So anyhow, if you don't know your actual risk number, give us a call and we'll help you figure that out. So
yeah, and this the last one's tax consequence, and it kind of plays into liquidity a little bit. So basically, if you're just in a taxable account that you could access at any point in time without any fees, let's say you sell something for a gain, you're going to have to pay taxes for that year whenever you do sell out of that product or out of that particular account. But if you're in a retirement account and you're under age 59 and a half, you may have penalties. There's just different variations with each plan or each type of account that you're in that could have specific tax consequences that you may not be aware of.
Yeah.
So I'll let Jeremy talk about the investment strategy.
So once you have your goals, your time frame, your risk all mapped out, and you quantify that, then the key is what strategy are you going to implement. So I'm going to briefly go over these. Usually there's 4 different strategies, and there's more than this, but 4 common strategies that we see, whether people that are not currently clients, they come in and we see that they're utilizing a couple of these strategies, or after we're done and go through our listening session and kind of come up with a strategy unique to their situation, we'll deploy a couple of these other options. But the first one is, and I think probably the most common, is just buy stocks. Just buy stocks, buy and hold, or buy and hope it works out. And then basically you're just hoping that you have time on your hand, and when you get to your end destination, that everything worked out. So that's definitely one way. You just kind of ignore risk and you just throw it in and hope it works out. Then you have diversify. So everybody's heard you got to diversify, you got to split the pie. And there's no doubt diversification is a mitigation risk tool, so you can mitigate risk. But basically, diversification also means that you're ensuring that a portion of your money is not working at any given time. So you have some components that are going up when other components are going down. A diversified portfolio in 2008 still lost around 28%. So if that's within the scope of your IPS, then hey, it might be a better tool or strategy than buying stocks and holding. So The other one is a tactical strategy. So essentially, we're looking at trends in the market. We're looking at the quantitative side of the market, but we're also looking at the fundamental side, and we call this quantamental. So it's a kind of a hybrid between the quantitative and the fundamental side of investing. And essentially, what we kind of parallel it to is you invest relative to what season we're in the economy. So no different than I have this jacket on today because it's cooler outside. I'm not going to wear this jacket in August when it's 95 degrees. So the reason why is because obviously I adapt based on what's going on outside. Well, the same thing with this type of strategy in the market. We want to change our underlying investments relative to what's going on in the economic cycle. So if growth is improving, what the Fed's doing, et cetera, we want to make those ongoing dynamic changes to keep you in front of that demand curve. And then the last one is we have clients that come to us and say, hey, I don't want to take on any risk directly. I want to push this risk off and I want some protection or guarantees. So you can transfer risk, and essentially you can transfer it off to a company that specializes in risk management, such as an insurance company. So with that, or with any of these strategies, there's trade-offs. There's pros, cons. With the transfer of risk, you're going to give up some gains or you're going to take on additional fees for the added protection. But at the end of the day, if that matches up with your why, then sometimes that's a good solution. And the last component of an investment policy statement, and by no means the least important, is you got to have a SUPS or a strategy update and progress strategy or session to have a maintenance program. So no different than your car or going to the doctors to check up every 6 months. You want to do this with your portfolio because as life changes, as the markets change, as your feelings about money change, you've got to have a strategy to keep you on track with your why. So again, this is an IPS investment policy statement. It is crucial if you're investing at all in the market. If you don't have an IPS that is based around your unique goals and your concerns, give us a call, 740-354-9585, and we'll help set your IPS up. And again, we thank you for your time watching Wealth Tip Tuesday. We'll come back next week and hopefully provide something good for you. Take care.